In the last video, I discussed a little bit about the concept of something being too big to fail in the financial industry, and I was also talking about why there are some of the same issues presented today, right now, that were in the 2008 mortgage crisis. If you haven't watched that video yet, I would recommend you go back and watch it. It will help you understand some of the concepts that are going to be discussed in this one, where I'm going to actually delve into what the issues are right now, why there is another mortgage crisis, why there is a debt crisis right now, and what some of the issues are presented that really there are no easy solutions for. And we'll go into that right away. First, we're going to start off by talking about the idea of quantitative easing. Seems like a really complicated term, but it's not. It's pretty straightforward. And it was actually something that was introduced during the 2008 mortgage crisis. So, as I mentioned before in the last video, it was a very bad economic downturn triggered by a mortgage default crisis where people were going bankrupt because they had taken on loans pushed by the banks that they could not maintain, could not pay. And what happened was there was a downturn. And as you probably remember, it was fairly bad. There was Occupy Wall Street. A lot of people lost their jobs, their homes, and it was not a great situation. But in fact, it was actually cut short. The recession was a lot shorter than it should have been. And that may seem a little bit strange. How can a recession be shorter than it actually was? Well, the government did something called quantitative easing. What they did was they pumped money in the economy to restart it. What they did was they lowered interest rates to really low rates so that people could take money with basically not having to pay anything for it. They had stimulus packages where they pumped money into infrastructure. They provided huge amounts of loans to the banks. They threw money at the problem and effectively paid their way out of a recession. And for all intents and purposes, it did actually cut the recession short. It stopped it, it brought the economy back. So you may be thinking, great, that sounds awesome. It did what it was supposed to, it solved the problem. Yes, with a significant caveat. It didn't solve the problem, it pushed the problem back. You could think about it like the government hitting the snooze button. They were supposed to wake up, they decided, you know what, I'm going to wait another 10 minutes before I deal with my day. What happened was, because they lowered interest rates so much, because they pumped so much money into the economy, they made it so easy to take out loans. Well, what do you think happened? People started taking out loans. When interest rates are 1%, 2%, a family that makes $100,000 might take out a $500,000 mortgage. People have been taking on more and more debt, once again, that they cannot afford realistically. At 1% to 2%, they can pay the fees, they can pay the mortgage payments, they can pay whatever interest is associated with that. But if interest rates go up, what happens? The same thing that happened in 2007, 2008, another mortgage crisis. And it is actually a much more serious problem now than it was before, because they didn't actually solve the problem in 2008. They just pushed it off. They pushed it, and now they're faced with a significant issue. And so you'll see the word market corrections. What that effectively means is, because so many people have access to what is effectively free money, it's really easy to get a loan right now for a really low rate. People are going out and saying, hey, I'm going to buy a house in markets like Toronto, Vancouver, and other places around the world where real estate's going up by 10% every couple of months. There's great returns on it, technically, and so there's a huge amount of demand, and it has pushed these markets up where, for all intents and purposes, what is considered a pretty crappy house, a semi-detached, might go for $1 million in these markets where it's super hyper-inflated. And what happens is, all these people are taking out these mortgages because they want to buy a home. Now you have people also buying real estate as an investment. So they're further pushing the market up. They're taking on more debt because, wait, if you can get 10% every couple of months, that seems like a pretty good investment, as long as you're consistently getting 10% and you don't lose the money. Well, that's created a huge issue because there's huge prices for real estate that really isn't worth what it's selling for. It objectively isn't. And what's likely to happen, and potentially to happen, is what's known as a market correction, and that's where prices will actually return back to the levels they're supposed to be at. Now, what's the issue with this? Okay, if they go back down, that's not a huge issue. Well, it really is, because what happens is these people have taken on these houses and investments. If markets start to turn down, if they start to go down in value, what's going to happen is people are going to start to sell. They want to sell their mortgages. What happens if people sell their mortgages? Well, people who may not have been looking at housing as an investment, but were looking at it, say, as a retirement plan, they just like the fact that if they had $1,000,000 home, then they're going to see, oh, the market's going down, maybe I should sell it. And then you see a mass amount of people that start selling off their homes that start a serious market correction that can cause a cascade effect, like we talked about earlier. And there are a significant amount of countries that are at a high potential for a market correction. Places like Canada, places like Australia, New Zealand, and Sweden. These are all countries where people, financial institutions have rated them in the double digits at potential for a market correction. And that's not good, because if a market correction does happen, it will have most likely a cascade effect. You're not going to have a 2 or 3% drop down in value, because when things start to drop down in value, people are going to pull out. They're going to try to preserve their investment, preserve their money, get a return. So they're going to sell, and it will have a significant effect that will cascade. And another huge issue created by quantitative easing that I talked about is people are taking on way more debt than what they can actually afford to. And this isn't just a North American problem. This is a worldwide problem. There was actually an article that came out within the last couple of days talking about what's going on in Hong Kong. Hong Kong is another one of those markets where it is a crazy real estate market that has just been jumping up again and at huge rates every year. And what's happened is, right now interest rates are fairly low, but they're expected to rise within the near future with the United States economy starting to heat up. And there was a recent report out of Hong Kong that if interest rates were to rise to just 3%, 3%, that's not significant, that's 1 to 2 points up from where it is right now, that you would be looking at an average person in Hong Kong would be paying 86% of their salary towards the mortgage. 86%. That is insane. That is not sustainable. And this is the issue. 2008, the problems with 2008 mortgage crisis were never fixed. They were pushed off. And now you have this huge debt bubble. And unfortunately, bearer of bad news, the problem only gets worse. Because here's what the situation is right now. You have this huge debt bubble where people have taken on way more debt than is sustainable. How does the government deal with this? There's no easy answer. There really isn't. Because here's what happens. If you decide to raise interest rates to get people to stop taking on debt, you potentially trigger a crash. Like 2007, 2008. You can no longer afford the mortgage you have. You declare bankruptcy because your rates are higher. But if you do not raise mortgage rates, what happens? Well, people continue to take on more mortgages. It's free money. Why wouldn't you buy a house if it's giving you a 10, 20, 30% return every couple of months, every few months in some of these markets? It legitimately is like that in Toronto right now. And so you're kind of screwed if you do, screwed if you don't kind of situation for a lot of these economies. And then, as I was talking about a little bit earlier, or rather in the last video, the idea of too big to fail. And this is really the linchpin of the whole situation. It's not just if Canada's housing market crashes, Canada's economy goes down, big issue. The real issue is if one market crashes, if one place goes down, they all go down. It has a cascade effect. It's effectively a ticking time bomb. So, it's a big issue. Real estate's potentially a huge problem. What can you do? Well, if you're looking at investing heavily into real estate in the very near future, say you're looking to buy a home, or just buying investment-wise a house, look very hard at the market you're looking into. If you're looking at investing in places like Toronto, Hong Kong, Vancouver, you probably want to wait. Potentially the mortgage crash won't happen. Potentially, but there's a high chance it will. There's a high chance that it will either cool off the market and nothing will happen, or it will crash. There's not a high chance that it will continue going on indefinitely, increasing to continuously higher rates. So that's the first thing. If you're looking at buying a house in a market, look at it. There's lots of places where it's fine, but if it is one of those inflated markets, probably a good idea to wait. If you're looking at investing significantly in real estate, probably not a good idea. You might want to diversify. It's okay to have some, because you can earn a pretty good return from real estate, but having a balanced portfolio, have things from different industries that make up that investment. And the final, and always the most important, if you are looking at taking on debt right now, don't base it off, can I pay the 2-3% that the debt is offering right now, or the mortgage is offering right now. Look at, can I afford this mortgage if my interest rate goes up to 8% in 5 years? That is what you have to do when you're considering taking on debt. don't treat the current interest rate as the interest rate that you'll have forever, because there is potential for it to increase, potential for it to go up, and you have to be able to manage those payments, and that's how you protect yourself from these mortgage crises, from these debt crises, and that's the best way to do it. So, as always, if you like the content in the video, if you found it useful, please like, share, and subscribe. And I'll be providing some more videos this week, probably related to Trump and what's going on with him and how he's affecting the American economy.